Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Tuesday, November 15th, and then we'll see how things look for the highlights for Wednesday, November 16th. And for those of you that listened to yesterday's video, the power has been restored, even though it was off much longer than was anticipated, but I was still able to piece things together and at least be able to produce a daily brief. So we did end up having a positive day after all, and we were up on Tuesday as much as we were down on Monday. That hasn't really done a lot to fix our short-term overbought condition and even a little bit intermediate term. So that's a little bit of a concern right now. And there's some news and things that has hit that may have an impact on the markets going forward. But let's go back and talk about what did happen. Right at the open, we had a higher open. The markets like the PPI that came out. The producer price index came in weaker than expected. That gave the market a lot of support, and it was able to move higher. So we opened up to R2 at 40.27. So we were getting above that 4,000 level, and that acted as resistance. That was the high of the day. We would end up being up on the day overall, but we never got back to that level as the day went on. And I'll have the chart to show you. Prices then stayed below R2, never really got back up to that level, and declined all the way down to the daily pivot. So we fell through 4,000, came back down to 39.74, and then we fell to the unchanged level, which, as I state a lot of times, that acts as a built-in support or resistance level. And in this case, it was a support level. We came down to that level, and then we're able to bounce back up. We rebounded and closed right at around R1 at 39.92. We were up 0.87%. So on Monday, we were down 0.86%. So, we're up 0.01% so far for the week. On above average volume, that did pick up. And the technicals are still looking more positive overall, but because of those strong days that we had and not any sideways to slightly down action after that, we still have a lot of our indicators that are overbought. Again, as I say consistently, it doesn't mean we have to stop. We can become overbought and then even more overbought. But a lot of times this can point to at least short-term exhaustion or some kind of a pullback. Inflation and interest rates are still the real growth concerns, are still the real concerns for growth. And then we have the situation going on in Russia, where apparently some explosions, some bombs have actually landed in Poland. That we'll have to see if that escalates things even more. Poland is a NATO country, and according to NATO, if one country gets attacked, they're all attacked and everybody comes to help. Well, the U.S. is a huge part of NATO, so we'll have to see how that goes for that situation. And we're getting a little bit more clarification with the midterm election. It looks like the House did or will eventually go over to the Republicans, where the Senate will stay with the Democrats. And again, the market likes that because it tends to tie the hands of the Congress to pass any new regulations or tax hikes or stimulus packages or whatever. The markets like to deal with what they know right now. Even if they may not like it, at least it's something that is knowable and they can work with. So here's the intraday chart showing that we gapped up to R2 right at the open, and that was pretty much the high of the day. We drifted sideways for a large part of the day. We trailed off a little bit, and then this is when some other information that I'll get to kind of started to hit the market, taking things lower. We came right down to the unchanged level, tested it 3 times before bouncing back up and closing right at R1, or roughly at R1. So what are some comments? The PPI came in cooler than expected, and of course the markets like that. In the wake of weak economic data, that's what they've been having in China. With this zero COVID policy, it's really damaged their economy. And there's some hope. Again, it's hard to get anything official out of this, but there's hope that new stimulus will be enacted to help stimulate their economy, kind of like what was happening a couple of years ago in the US, just putting money into the economy, hoping to get things going again, and that they might also be ending this zero COVID policy. That in and of itself is pretty much just in China, but there are so many companies that do business in China. There's a lot of Chinese companies that do trade on the New York Stock Exchange. And so that added a little bit more positivity to the background. And then the Bank of America, global, and I'm still dealing with this inner ear being dizzy all the time, so please forgive me for that. Bank of America came out and showed that in their customers, they have a large percentage that's still in cash. And you can initially look at this as a contrarian indicator. If a lot of the people who aren't professionals who invest in the market, they're sitting on the sidelines, when that gets to a really high level, that's like looking at extreme sentiment as negative. Well, if we start to go higher, then a lot of that cash is then going to come into the market and could help support higher prices. That was taken as positive. Also, the dollar was weaker and interest rates were down. That helped stocks. And then on the short term, we still have the rate of change with the 5 period, as well as the Stochh RSI, our full stochastic study, the Williams percent R, those are still extreme positive, and those are our short-term indicators, the majority of them. And the intermediate term, we still have the bullish percent index, both CCI charts that I look at, the PMO studies with multiple different studies on one chart, those are all still extreme positive as well. So we really haven't worked off this overbought condition. And I do have a chart to show you this, where the new highs and new lows, they're not breaking out, but they are showing some improvement. They're holding up. Okay, but we're not seeing them as the market's going a little bit higher. We're not seeing a flash of new highs coming out, at least yet. And I took the 30 to the 5-year off because it's gone a number of days now and it's no longer inverted, where we still have the other yield curves listed here that remain inverted. And sentiment is still positive. As far as the economic reports, the Empire State Manufacturing, it came out much better than expected at 4.5. They expected it to be at -5. The last time we got this report, it was at -9.1. That's just the New York area, but New York is a very important area and a huge part of the economy. So to have that be better than expected was seen as positive. And then this was the big one, the PPI, or the Producer Price Index. It was up 0.2% on a month-over-month basis, much weaker than the 0.5% they expected. If you take out food and energy, of course, the things we have to have, the PPI was unchanged on a month-over-month basis, and they expected it to be up 0.4%. So that was weaker than expected too. And now that's feeding more into this scenario that maybe inflation has topped out and is starting to come down, because this is producer prices, which eventually work their way over into consumer prices or into the CPI. Our trend is neutral, but it's getting stronger. It's actually crossing above the moving average, and I have a chart to show you that. And the green line is still on top, so that is positive. I've kept our bias at positive after the up day, where I was more mixed after yesterday's session, and the momentum I kept as positive, and I'm still keeping that as positive. Just to show you this, I know there's different people that watch the videos on different days. This is comparing the action in 2008 to the current action that's in white. And this is a few days old now. This was taken last Friday on the 11th, and how the S&P had been spiking up. But this is what happened back in 2008, right before we saw things get really bad. So we've been following this fairly closely, but at the same time, I personally just use this as a guide. Just because we've been following it along, yeah, we should be aware of this. And yes, something like this might happen. But at the same time, we have to take today for today, but just use this as some kind of comparison. All right, here's the ADX showing how we're starting to come back above the moving average. Now we're still below 20. So some of you that are a little more aggressive, you might see this as a trend that is starting to develop with the green line on top. Even though it's declining, it's still positive overall, and the ADX should continue to advance. That would then help us to develop into a new trend. From a pretty conservative state, I'm still saying that we are neutral just because we still continue to be below 20. Here's the daily chart showing how we came all the way up to R1. We went a little bit above R1 right here, but that acted as overhead resistance. And then down at the bottom, you see where we picked up a bit on the volume. And here's our moving averages. We're currently dealing with the 200-day exponential moving average. And that's calculated a little bit different than the simple moving average. A simple moving average takes all 200 days and treats day number 1 the same as day 200, where an exponential moving average puts more weight to prices closer to now. Well, a lot of folks still just use simple moving averages. And even though this is important, and it did act as resistance as well, it's the 200-day simple moving average that will get the most press. And you can see this happened back in August when we went right up to that 200-day simple moving average and then fell back. If prices can continue to advance and get up to this simple moving average, we're really going to be watching that. And it's going to take some real buying and some real volume to be able to push us through. And that would be the first time since last spring that we've actually been above the 200-day moving average. This is just a warning sign that I wanted to show you, where even though we had an up day and we're in a more positive environment, the STO, or the Swinland Trading Oscillator, based on price and volume, they are still declining. They're above zero, so they're positive, but they are showing some weakness here. And sometimes this can be a leading indicator for us. Here's the new highs and new lows. We saw just a little breakout of new highs, but it's enough to keep our 5-period moving average still above the other moving average of the new highs and new lows. And our 10-period differential, it's still pretty much flat to slightly declining currently. So what's our outlook then for Wednesday? The technicals, they remain positive, but we're still short-term overbought. And we still have a few intermediate term charts that are overbought. We have the weekly mortgage index that's coming out, import-export prices, retail sales. That'll be the biggie for Wednesday's session. Industrial production and capacity utilization, that'll be coming out, as well as inventories. And then we have the NAHB housing market index. So we're getting some more housing data to see if that's still declining or if there's any improvement. We have Russia, Ukraine, and then I listed Poland on here just because we now have had bombs that have dropped in Poland, and what's going to happen from that, if anything. We'll have to see how that works out. We still have the situation in China. They're trying to ease their lockdowns or their zero COVID policy. Interest rates and inflation, those are the big concerns for the market. We might get some more Fed speak. And again, the midterm election, it's still not definitely over yet. So I still have that highlighted as well. So our scenario's not going with the down scenario right now, other than the fact that we might be short-term overbought and a little bit intermediate-term overbought. And so that may produce some downward pressure. Again, if we do start falling, we're going to be watching for the intensity of the selling because these other geopolitical events could easily come to the forefront and have, whether it's a short-term or significant impact on the market. That can always happen. Then I have the up scenario just in case you use the ADX and you are a little more positive about what the trend is doing. because the technicals still remain positive, but they are showing, at least in the short term, overbought and a little bit in the intermediate term. Our scenarios, they're improving as we're going up. We're seeing sector rotation improve a little bit. Our different studies, our longer term studies, our VIX study, our 5-day study of the equity put call ratio, those all produced extreme negative readings, and now they're starting to show some improvement, which taken together often give support to the S&P 500. Our technicals are still looking better. We're still dealing with that 200-day exponential moving average. If we can break through that and then get to the simple moving average, and then our pivots, fib retracements, and then other levels of support and resistance, we're constantly watching those areas. And as I see those, I will point them out to you. And then I'm going right now again with the sideways scenario because we're still below 20 with the ADX. So our conclusion, the S&P is positive, but it's still overbought. That's kind of in the big picture. Short term, we're overbought. Intermediate term, slightly overbought. Long term, we are still negative. So thank you. Have a wonderful Wednesday. I still don't know about doing a full length video at this time. I'll at least be putting out a daily brief for Thursday's session, and I'm just kind of taking it day by day.